So this is Juan. I'm one of the co-founders with Darwinex. It's been a long time that I don't do one of these, and it's great to see all these old faces and new faces who've joined. So my agenda for today is to give you my personal rundown as to why we have chosen to pivot our investor business model, and explain the reasoning behind it. And then we have a range of questions that have been kindly posted by members that I will publicly discuss with you guys. And then after we're done with those, if anybody has any outstanding questions or comments, then I'll be very happy to do my best to explain them. Okay, so thank you so much. Let's get going. This meeting will be recorded, so hopefully anybody who hasn't had the time to listen to this or wants to listen to it again, or they want to leave, it will be posted out into the community forum for everyone's benefit. So without further ado, as you know, business model pivot and why we've chosen to grow the investor base. So as you know, all of Darwinex is designed to solve an independent trader's key issue. And the issue is that it's a long and winding road indeed from an aspiring to a professional asset manager. It takes time, it takes personal capital. Typically, the first thing you have to do is to accrue a track record, then somehow you tap somebody else's investors, and as of today, the best way to do this is to work for a third party on a 9-to-5 job. And Darwinex is all about trying to fast track this time to get from a point where trading is costing you money to the point where you can legally grow third party money. And that's what we set out to do about several years ago with the Darwin asset, which we're trying to create here, which is for now a technological construct whereby you can legally earn provider revenues, or you can legally tap into any strategy anywhere. But to get to the point where it's an asset, we need to build trust. So I guess I have an ability to say things in a complicated way, but I'll try to say it in the most reasonable way that I can think of, which is, how do we overcome the chicken and egg problem, whereby when you don't have traders, you don't get investors, and when you don't have investors, you don't get good traders? Because that's the issue we've been going around for several years. And the answer to that is by building investor trust. The first and most important thing, the one thing that makes everything else easier or unnecessary from the standpoint of a manager, is to earn investor trust. Because if you have investor trust, in other words, investor capital at risk or assets under management, then together with the Darwin, what you can do is, the more capital the investors risk with you on this axis, the more revenues that you make as we grow the investor pie. So, it's a kind of tit for tat game, which is actually about two variables. The better you grow investor capital with your alpha, with your Darwin performance, the more investor profits there are. And it's a self-fulfilling prophecy, because the more investor profits you've got, the more revenue you accrue, the more AUM you can show on the exchange, the more trust you get, and it starts feeding in and out itself. So alpha is, in other words, the rate at which the investor capital that is risked translates into provider revenues. And the reason we've changed our business model is because we want to grow investor trust by growing investor performance. And when we say investor performance, we say Darwin performance. So I guess the one summary for this is, we're trying to look at the one parameter that makes everything easier or unnecessary. What is that parameter? Investor trust. Investor trust is the size of the pie. The more we grow the investor pie, the more revenues there will be for those who perform and paid out to them. And the more trust and the more performance we reward or we give to that trust, then the more aspiring traders Darwinex will get, which will feed its brokerage revenues. and the more established managers we will get, and which we will share with a new revenue model as part of their revenues via the success and the management fee. So I want you all to note that there's not much point to discussing how we share the revenues if we don't have the investor trust to begin with, because discussing about how we share revenues is a zero-sum game, and it's actually a waste of everyone's time if we don't have the investor trust. And up to now, we have had reasonable success into growing investor trust over the years, but we haven't had as much success as we feel we need, in the sense that there are some managers who have already made hundreds of thousands of revenues, but the aspiration is to have many more managers making hopefully millions of revenues through us. And because that's our aspiration, we have really looked long and hard as to how we're going to increase investor trust. Okay, so with that in mind, I'm going to go to the online resources that we have created to explain this pivot and review the changes so that we can have a base to start the discussion and go through the questions. And I'll provide you with hopefully a background as to why we've chosen to do the different changes. So the first change, which is a very important change in order to increase investor trust, is to position the Darwin at in a better way to tap a larger investor pool, which is people who are looking for an alternative to investing their assets in the stock market. Up to now, as you know, the target value at risk we had was positioned at the level of the Apple stock with a value at risk of about 10%. And what the change we've done is to reduce by 35% to take the risk to a 6.5% value at risk, which is roughly comparable to the S&P 500. Why have we done this? Well, we've done this because we have noticed by analyzing investor behavior that the old Darwin was generally too volatile. And because that Darwin was too volatile, we saw that the investors had a tendency to buy the highs and sell the lows, which is an evidence of loss aversion. Now, what happens when we have a lot of investor trust that buys the highs and sells the lows? Well, if we come back to the old slide, that basically means that we are wasting investor performance, or like we're wasting trader performance, because the investor doesn't make any money. As a result of that, he does not beat his own high water mark, as a result of which he's not paying providers any revenues. So again, the first reason we changed the target risk is because we were seeing that the default risk was too high for existing investors. Note that this actually doesn't change anything other than the marketing optics of this. If anybody wants to continue having the same old risk, leverage is available to gear up from 6.5% to 10%, and even all the way up to 20%. So if an investor wishes to keep the same old risk as he had before, we still allow that. So this is, up to now, a cosmetic change. Whilst we're at this, can somebody confirm, or does anybody have any questions on the point of why we've changed the target risk? Because this is probably a good point to start having the Q&A. Okay, seems like we have everybody still on board. So again, the goal is to increase investor trust and also translate whatever investor trust we've got into more performance, and excess risk was getting in the way of that. So we've got rid of excess risk. The second and possibly most important point on this is the fact that up to now, our business model from the investor side was 100% brokerage based. Up to now, investors were paying $25 per million in terms of brokerage commissions when they replicated at Darwin, and that was the only revenue source that Darwinex derived from investments. Now, I think those who know us over the years understand that we're here to disrupt asset management. We're not here to churn investing customers, but it is true that any smart investor would have seen through the fact that our walk didn't follow our talk, in the sense that how credible is this that we care about investor trust and investor performance, and the only place we make money is from brokerage. So what we've done here is changed our investor model, well, actually a business model, as part of an initial change, where initially what we want to do is to give out to investors as much performance as there is in the Darwin, meaning we are going to charge the same amount of money for an account with 200 to 500 euros, which is the starting minimum investment in a Darwin. We're going to charge the same amount of money that someone would pay when trading several million with Goldman Sachs, assuming Goldman Sachs accepted them as clients, which most likely they would not, with 200 to 500 euros. Okay. Now, this is part of a broader change in the sense that we're exploring the options for us to make Darwins available through brokers other than the Darwinex broker. But more importantly, what this does is that every unit of raw performance, so every unit of raw performance translates into investor performance for the managers, meaning up to now, what we've done is grow the success fee based, because for every trade, the investors make more money, which means that ceteris paribus, if we didn't change the success fee, then that providers would be making more money. Now, of course, this comes at a cost, and Darwinex is a business that has to invest in building trust. So we have to make revenues somewhere from investors, because if we don't make revenues somewhere from investors, then we cannot get investors. And if we cannot get investors, then we cannot pay anything to providers. So it's a chicken and egg, and it has to come from someplace. What decision have we made? We have made two decisions in this regard. The first decision is that if we are to be credible with professional investors, we have to be meaningfully vested in investor success. And the best way to be meaningfully vested in investor success is to share in the success fees that investors pay for the Darwins. So if we look at the cumulative change so far, we have grown the profits by an amount that depends on how much investor commissions investors were paying before, which is a function itself of the rotation. And now we are sharing in this growing share of profits at a higher rate. Now, I have been personally answering many of the questions that have been posted in the community forum, and many people said, oh, before you paid 20% success fee, and now you only paid 15% success fee, ergo every provider is worse off. And the answer is wrong, because to own 20% of a pie with 100 kilo pie is potentially far less than owning 15% of a 1,000 kilo pie. In other words, you cannot compare the percentages if you're comparing apples with pears. Okay, so we have done a very detailed impact study to understand what is the change from one day to yesterday when it comes to looking at this, and we've published this out here in the impact calculators, and I encourage everybody to check that out for their particular Darwin. As you'll gather, the more rotation, I mean, if we just look at the zero sum part of the game, which is how we split up today's pie, then all other things equal, the managers who have more rotation are going to have relatively speaking, better performance than the managers who have low rotation. But I encourage everybody to think that this is looking at the last 5% of the issue. The bigger fry, which is the 95% issue, is that we're doing this change to grow investor assets under management 10 times over, so that everybody comes out of this winning. Okay, that's the real reason. But if we want to go for more professional investors, we have to convincingly prove to them that we are aligned with their success. And the most credible to do that is to share in the success fee that we charge the investors. Last but not least, there's an area here where in hindsight, I see that we could have done a better job in communicating. And also there might be a better way of articulating this. But the fact is as follows. For Darwinex to take on an investor with 1,000 or 2,000 euros, Darwinex as an FCA regulated broker has to incur a cost if in onboarding said customer. And that cost boils down to infrastructure costs we have in order to support those investors until they are fully onboarded in terms of question to the customer success team. There are payment fees. For instance, if you wire 2,000 euros from certain countries, the wire may well cost 30 to 40 euros, and we eat as a large part of that wire. The issue is even worse if that investor is depositing by credit card, and there are a whole host of euro level costs that we incur that are quite sizable relative to the size of the small deposits. And for now, what we have decided is the best way to overcome those is a management fee, which if the Darwin is active all year, will amount to a maximum of 1.2% management fee per year for the standard 6.5% value at risk Darwin. Now, importantly, if a Darwin is not active and is not trading, then we do not charge the management fee because we don't want to charge for something when we're doing nothing. Okay, this management fee only applies when the Darwins are active and to the extent that the Darwins are active. If a Darwin is inactive, then we do not charge that fee. Now, because we are honest and possibly a bit stupid, we have put the number of 1.2% up there, where we could have said on average it's less because the Darwins are not that active. There are kind of small points there, but for us, transparency is very important. So yes, we are adding a management fee because we have fixed infrastructure expenses. We have a lot of developers. We have very substantial FCA compliance costs, and they have to come out of somewhere. And if we only have a variable revenue base, meaning brokerage and performance, then it is very, very hard to incur infrastructure risk as a company where you don't have a fixed revenue base. Now, is a management fee the best way to solve this issue? Well, we think it is. And if we figure it isn't, then we will change it. But for now, I think that's kind of my explanation as to why we've done the changes we've done. So far, I only have one question, which is whether or not the traders could have a bonus if they beat the S&P 500. And the answer is the bonus will get a 15% success fee from the investors that trust them. And whether or not investors trust them is to some extent down to whether investors trust Darwinex. And then once investors do trust Darwinex, which is the whole point of this change, it's a question of who of the managers within the Darwinex change they choose to trust the most. So the answer is no, not that way, but from the standpoint of an investor, we think it's easier to pitch the risk at a lower level. So guys, go ahead trying to ask me questions. What I'm going to do now is go through the list of questions that have been posted by fellow members of the forum and explain what's going on. So I guess everybody can read the question that's tried to post here. And I think the best answer to provide here is to say the risk manager is right now very intransparent towards the actual Darwin providers, and we are working on making this less the case so that Strider FX, we are trying to give you a much better indication as to what is the position size that you should keep in order to stay within the tolerance of the value at risk level. So the answer is yes, we're working to make this happen. This requires technological change. Up to now, all our resources have been focused on this business model build, which is a major change under the hub of the Darwin Exchange. And this is very much an area where we want to focus going forward, to give you a better control of both the risk management of the investors as well as the execution, as we've done recently with the execution overview section for the managers. So expect more to come in this sense. And we understand your frustration and we share it. So this is a pretty good point in terms of us trying to engage more professional investors, that we have to engage more professional managers. And I mean, there's a long list of things that comes to mind when I look at this question. So I guess one thing that has become very clear to us, which is not clear in our positioning yet, is that Darwinex is a meritocracy. And a meritocracy means that we should give better treatment to the managers who merit the better treatment. For instance, what does that mean? There are certain managers who bring a lot of value in the sense that they build trust and performance for investors, and those managers will always have the CEO personally answering their points of the community. There are certain other managers who bring neither performance nor trust nor constructive attitude to the community forum, and we are thinking of ways to keep Darwinex very much a meritocracy so that everybody can have access to the information and it's transparent, but we're trying to preserve the greater community from selfish attitudes and unconstructive feedback given in community forums where we are basically getting too much, as this is not my words but a fellow manager's words, crap to inside ratio. So that's one point. The other point is I understand the frustration in terms of managers not having communication channels to announce that, for instance, they're going on holidays. Now, the main worry that this user, Lotus Buddha, has, that Darwinex is going to charge a management fee whilst the managers are inactive. This is a failure in communication. As we've said, the management fees do not apply when Darwins are inactive. Whether they cease abruptly or less abruptly, we do not charge a management fee when the Darwins are not active. So I will try to clarify this, but this concern is a failure of our communication. We apologize for that, Lotus Buddha, but you need not worry about this one in particular. So there's a good point here by Debian, who's saying the fact, so I'm trying to open this up. The fact that the Darwin pays 60% less brokerage does not mean that the investors in my Darwin are going to earn more, because I try to make an efficient operations. Then this is a discrimination of those investors who will be disadvantaged compared to investors who invest in Darwins who spend So I totally understand this, but two comments on this. The point here is not to look at a zero-sum game, which is how do we compete for the investors we've already got, but how do we all cooperate to get 10 times more investors in this case? That's point one. And point two, whilst I totally understand that Debian is looking at this from his own personal standpoint, I think the way to look at this is from the investor standpoint. And what the investor gets from this is that they get a much broader choice of Darwins into which to invest, because the Darwins that used to have a lot of rotation and who used to be penalized by the excess brokerage will be a lot more attractive. So in this case, from the standpoint of an investor, the investor is immediately better off, which hopefully will increase investor trust, which will hopefully translate in 10 times more investor revenues, which will mean that even if Debian loses, say, 30% of investor share, he's still 5 times better off because we've grown the investor base 10 times over. So I understand Debian's concern, but we are Darwinex and we're here for all managers, not just the individual managers, and we have to look at the bigger picture in the bigger scheme of things. There's a question here on what is the expected effect of this change on divergence, and I have to say that whoever's asking this question has not understood that this has no effect on divergence. So the answer is none, other than whatever divergence comes from the fact that we grow assets under management. This is a point that I sympathize with, and this is the situation where some managers actually feel disadvantaged because they have chosen to back their own Darwin, and they're sort of paying Darwinex for the fact that they're paying their own Darwin. And whilst I sympathize with this, I also have to ask them to sympathize with us in the sense that Darwinex is a business, and as a business, we have to make revenues from our customers, because if we don't make revenues from our customers, then we cannot service our customers. So the choice we've made here is to give the Darwin managers a choice whether to trade through their MT4, in which case they pay high brokerage charges, or they can back their own Darwin, in which case they pay far lower commission charges, but instead they also pay a share of the success fee and a share of, and the management fee to Darwinex. It's their choice whether they invest in themselves through MT4 or the Darwin. And we have to make money one way or the other, because there is a cost to creating a Darwin, there is a cost to hosting the Darwin, there's a cost to a whole host of things which we're no longer going to get back via the brokerage fees. So we have to make it back somewhere. So I very much respect that managers, Darwin providers, make the choice to back their own Darwins, but if they think they are better off by investing in their own MT4 than they are by investing in their own Darwin, they are very welcome to make their choice. From our standpoint, we have to cover the bills. So Klondike FX is asking us that we're planning to get rid of the diversification rebates, which were created to reward the diversification. And the answer is yes, we have gotten completely rid of them, so that we've solved the problem at root. And instead of putting a plaster on a self-inflicted wound, what we're doing is we're getting rid of the wound to begin with, so that the need for the diversification rebates doesn't exist, because the disincentive to diversification by way of excess brokerage is gone. So that's the idea. The bigger picture here, Klondike, is that the getting rid of the brokerage fees is part of the bigger change, where we want to explore the option of making Darwins available through brokers other than the Darwinex broker, in particular to more professional investors. So the goal here is to explore the option whereby we could say get the NTI Darwin, make it available to professional investors through the Goldman Sachs Prime broker, and by charging the same fees as the Goldman Sachs Prime broker charges, we have made ourselves indifferent to whether we get paid management fee or success fee through the Darwinex broker, or management the success fee through the Goldman Sachs broker. That's really the bigger consideration here. It's not so much the diversification rebates. So yeah, so Klondike is asking a very good question, asking what is the effect of waiving the, I guess the question is whether the impact calculations have been done on a gross basis without diversification rebates, or on a gross minus diversification rebates versus new. And my answer to that is I don't know, because unfortunately also the diversification rebates were a function of the portfolio diversification. So it's actually, for us to calculate the impact, we have to go on an investor portfolio individual basis. And that in itself already has a big bias in the sense that the portfolio construction or composition would have substantially changed if the investor hadn't had to had to pay the brokers to begin with. So honestly, Klondike, I really don't think, I understand your point. It's a very clever point as ever, but I think in the bigger scheme of things, of trying to grow investor AUM 10 times over, there are better uses of our time to build a pretty sophisticated simulation engine to calculate the effect on our portfolio, which wouldn't have been built in the way it was built if the charges had been what they were at the time to begin with. So I think it's a very clever question, but I don't think it's worth the opportunity cost of resources. So Naragot is asking, with lower broker commissions, the affiliate commissions will drop by 60% proportionally. Do you have any plans to reload this system? And the answer is yes, very much so. We are working on several changes whereby we will make a new partner model available to selected partners. But the important thing here is there's a saying in Spain which basically says, doing this amounts to selling the car to buy fuel. So we have realized that charging excess investor commissions amounted to selling the alpha to buy fuel, and that's not good for investors, Darwinex, or provider revenues, and that's the reason we've decided to change that. How that affects partners, we'll see, but we have to see that we grow the investor trust base, because otherwise, again, we're stuck with the same model, and we're here to grow the investor performance, provider performance, and partner performance by 10 times over. And we think the best way to look at this is to grow the pie substantially instead of looking at the zero-sum game of all this. Old School has a question, which after all these changes, do you have any plans for a new DWX? And the answer is yes. There are very strong changes coming in this direction, with a complete revamp of certain key parameters to make the Darwins more performing in a way such that ideally both Darwinex and passive investors can deploy capital at the most performing Darwins. So there is more coming this way, but I don't want to anticipate at this stage. I was told to zoom the screen. Unfortunately, I've only read this a bit late, so I'm very sorry if people couldn't see this. I'm really sorry about that. So from now on, I think I've run out of questions from the Q&A. And I'm going to now look at the questions that you've been posting for all this time. There's a point that DTEX Malling who's saying, of course, there's an impact on divergence with a leverage of ×3. And of course there is, but what I've said, and I'd like to clarify now, is divergence is a function of the investor assets at risk. So the more investor assets at risk, then most likely the bigger the trades that are sent to the market, and therefore the bigger the slippage impact. And of course, if you increase the leverage, then you have the investor assets at risk, which impacts the divergence. But that's really a question of the investor choice. And whilst we have changed the way we present the choices, we have not changed the way in which the choices translate into divergence. That's the point I wanted to make. So Lars here is making the point that the new model wouldn't look that much better compared to the old model with diversification rebates considered. I do, of course, understand and agree with the changes that made, though. So I guess the point to be made, Lars, is that we were by charging $25 per million into the Darwin curve, we were giving investors the impression of a certain performance, which was actually worse than the performance that they would get by actually getting $10 per million. So in that way, I think we have all made ourselves a disservice by underselling the performance and therefore generating less investor trust. So again, I'd like to really focus at the bigger sum question of let's actually give the investors the most performance. That will hopefully grow the biggest amount of trust, which will hopefully translate into the biggest amount of provider revenues. And then let's worry about splitting the buffalo once the wolf pack has hunted it to begin with. And right now, I think it's much more important that we cooperate, like the wolf pack cooperates to hunt the buffalo, the investor trust, before we argue about who's going to get the chest and who's going to get the heart and who's going to get the rest. There's a question about the private label. I don't really, DTEC, I don't want to really go into the private label. I guess what I can say is that Darwinex will be a venue where providers trade just one account, and we give them as many venues to land investor trust as possible. Okay, that's all I can say at this stage. Okay, and Lars has as usual, a very good point going on in terms of transparency, and he thinks it's a very important point to mention. And I think I have to reflect on 8 years worth of trying to explain a concept, a complex concept to an unknown audience. And I guess if I had to summarize the key lessons out of this point at this point is that raising 200, 500, or 1 billion euros isn't all that hard if you pitch the right product to the right customers. And unfortunately, when you create a new product, you don't really know what the right product is. So this is kind of a pivot to get closer to what we feel the right product is for the right customers. And if I had to reflect on my personal journey at this point, is that I came into this thinking that the system was unfair towards retail investors in the sense that they didn't get the same choices as professional or wholesale investors. And I still think that part of our vision has to be to give every investor all the choices. But also as a company, if we have to educate every investor on understanding a complex financial product, then we will run out of money far faster than we build investor trust. So with that in mind, I think we need to get to a point where we explain the bare minimum to the right investors to make the most informed choice. And I think having to explain diversification rebates makes things unnecessarily complex. I think there are better ways to put the right product with the right investor than creating and therefore having to explain diversification rebates. I guess that's my position. I totally understand on the point that you've made, but I think the job here is to grow the investor pie by pitching the right product to the right investors. And what we've tried to do is bring the Darwin closer to being the right product so that we can start approaching what we think are the right investors without leaving behind the alpha investors who are willing to put in the legwork to understand how all this works and go to the webinars. So we will always remain open to the kind of guys who really come and pay attention to this webinar. But I think we have to be laser sharp and laser focused in terms of what product we offer to what investors. And if you have any suggestions on how to improve that, they're very much welcome, because if there's one thing we know is we are far from perfect. But we do try, and we will continue to keep trying. Okay, so I think it sounds as though we have run out of questions for now. I understand there is follow-on demand for a private label, and there will be more on the private label when the time is ripe. For now, all I can say is we have done this change, and we have invested a significant amount of resources into doing the technological changes, and a significant amount of resources into trying to explain this as best as we can. Very clearly, there are things we could have done better. I guess in hindsight, I think we should have probably offered people the option of seeing the Darwins on the platform before we announced the change and the gradual obligation to switch over. I also think that there is a mismatch between the complexity of the product that we're offering and part of the audience that's currently buying it. I don't think that's good for the audience, the providers, or Darwinex, and therefore I think we need to realign things. But all things considered, we will keep plugging on until we get there, guys. I mean, that's what we do. We try, we fail, we learn, we try better, and we keep going onwards and upwards. So unless there's any further questions, I think we are done with today's subject. And I will make sure that we put this out there for recording for anybody who wasn't there. I apologize for the delay and the technical issues in the beginning. I hope we learn for the next iterations. Okay, so unless anybody has any more questions, I think we're done here. All right, so thanks very much, guys. It's always a pleasure. And keep the questions coming, keep the feedback coming. There's changes coming after this. I think if you've known Darwinex for a while and if you've understood now the reason why we're doing this, you can sort of figure out where the ship is going. But we'll try and do a better job of explaining everyone. Okay, thanks very much. Take care and happy trading. Bye bye.